Hello everyone! In this video series, we're going to talk about PFRS 3 business combinations. Aside from PFRS 3, other relevant standards on business combinations include PAS 27, separate financial statements, and PFRS 10, consolidated financial statements. We'll cover PAS 27 and PFRS 10 in a separate video series. Business combinations are very common in the business world. Here in the Philippines, historically, banks have engaged in several business combinations. For example, just this year, Land Bank acquired UCPB. And just last year, Union Bank acquired Citibank. So business combinations are very common. To give you a quick overview on business combinations, this is where an entity, referred to as the parent, obtains control over another entity referred to as the subsidiary. A parent may have several subsidiaries. For example, Jollibee is the parent to several subsidiaries, including Chowking, Greenwich, CBTL, Mang Inasal, and so on. In business combinations, we're not just combining businesses, but we're also combining financial statements, particularly the financial statements of the parent and its subsidiaries. You may have seen sample financial statements from PSE, which bear the heading Consolidated Financial Statements. By consolidated financial statements, this is the combined financial statements of the parent and its subsidiaries. We'll be learning how to prepare consolidated financial statements in this video series and the next. A business acquisition or takeover may be friendly or unfriendly. Friendly if the target company is willing to be acquired, and unfriendly or hostile if the target company is not willing to be acquired. In a hostile takeover, the target company may employ a number of defensive tactics to prevent the takeover from happening. And these defensive tactics are often cloaked in very colorful terminologies, such as poison pill. Poison pill is a provision in the bylaws that deters the prospective acquirer from pushing forward with the acquisition. For example, the bylaws might state that should a takeover occur, the entity will issue a certain number of shares to its existing shareholders in order to dilute the ownership of the acquirer. Another example is greenmail, wherein the target company tries to buy back its shares from the acquirer by offering a very premium price for the shares. Hence, it's called greenmail because it's an offer that the acquirer will find difficult to refuse. In white knight or white squire tactic, the target company runs to a white knight to get acquired by that white knight instead of this other acquirer. In Pac-Man defense, just like in the game, the target company attempts to fight back and acquire its prospective acquirer. Selling the crown jewels or scorched earth entails selling or destroying the asset of the target company that the acquirer is after. Let's say that the target company has a highly valuable patent that the acquirer wants to have. Instead of being taken over because of that patent, the target company instead sells or destroys the patent to prevent getting taken over. In shark repellent, the target company intentionally decreases its value through a number of ways, including taking on a huge sum of debt to discourage the acquirer. Other defensive tactics include leverage buyouts, mudslaying defense, and defensive acquisition. There are 4 types of business combinations. In a horizontal business combination, an entity acquires its competitor. In a vertical business combination, an entity acquires either its supplier or its customer. In a conglomerate business combination, an entity acquires another entity from a totally different industry. And lastly, in a circular business combination, an entity acquires another entity from a different but related industry. A business combination may be structured in a number of ways, such as the following. One business becomes a subsidiary of another. This refers to a stock acquisition. Two entities are legally merged into one entity. One entity transfers its net assets to another entity. This pertains to acquisition of net assets. An entity's owners transfer their equity interests to the owners of another entity. This occurs when the shareholders of one entity transfer their shares to the shareholders of another entity. Two or more entities transfer their net assets, or the owners transfer their equity interests to a newly formed entity. This is sometimes termed as a roll-up or put-together transaction. Lastly, a group of former owners of one entity obtains control of a combined entity. For our discussion, we will simply focus on stock acquisition, which is bullet 1, and acquisition of net assets, which is bullet 3. Once again, our discussion will focus only on two structures or methods of business combinations. These are acquisition of net assets and stock acquisition. As the term suggests, in an acquisition of net assets, the acquirer acquires the net assets or the assets and liabilities of the acquiree. Whereas in a stock acquisition, as the name suggests, the acquirer acquires the voting common stock of the acquiree. In an acquisition of net assets, the acquirer must acquire 100% or all of the assets and liabilities of the acquiree. Whereas in a stock acquisition, the acquirer must obtain control by purchasing more than 50% of the voting common stock. Take note that this has to be more than 50%. If it's just 50%, then there is no control yet. Now, do not get confused with this threshold and the threshold for significant influence. Significant influence is presumed when the investor has at least 20% ownership interest, whereas control is presumed when the acquirer has obtained more than 50%. So do not confuse the two thresholds. In an acquisition of net assets, normally only the acquirer continues to exist after the acquisition. Whereas in a stock acquisition, both the acquirer or the parent and the acquiree or the subsidiary continue to exist after. They continue to prepare their own separate financial statements, only that the parent is required to consolidate the financial statements of the subsidiary every reporting period. But both parent and subsidiary continue to exist separately after the stock acquisition. In the books of the acquirer, acquisition of net assets is recorded by debiting all the assets acquired and crediting all the liabilities assumed, and crediting as well the consideration transferred or paid. The balancing figure is either goodwill or gain on bargain purchase. Whereas in a stock acquisition, the acquirer records the stock acquisition with a debit to investment in subsidiary and a credit to consideration transferred or paid. Goodwill or gain on bargain purchase is not recorded in the books of the acquirer in a stock acquisition. There are two classifications of acquisition of net assets: statutory merger and statutory consolidation. In a statutory merger, only one of the entities continues to exist. That's expressed as x plus y equals x or y. On the other hand, in a statutory consolidation, both entities cease to exist and a new entity is formed. That's expressed as x plus y equals z. Asset acquisition, as opposed to acquisition of net assets, reflects the acquisition by one firm of assets and possibly liabilities of another firm, but not its shares. Asset acquisition sounds very much alike with acquisition of net assets, but these two are different. In asset acquisition, an entity acquires one or a few assets of another entity, whereas in an acquisition of net assets, the acquirer acquires all of the assets and liabilities of the acquiree. Asset acquisition is not within the scope of business combinations under PFRS 3 because the acquisition of one or more assets is not an acquisition of a business. Let's take a look at this illustration. You may pause the video to read the illustration thoroughly on your own. Here, we are required to prepare the journal entries in the books of the acquirer if the acquisition is an acquisition of net assets, particularly a statutory merger, or if the acquisition is a stock acquisition. Recall that in an acquisition of net assets, we debit all assets acquired, credit all liabilities assumed, and credit as well the consideration transferred. And then the balancing figure is either goodwill or gain on bargain purchase. Here, the assets acquired are current assets, $350,000, plant assets, $810,000, and we have liabilities, $450,000. The consideration transferred consists of 100,000 shares and a stock price contingency. Each share has a par value of 1 peso and a market value of 8 pesos. We credit common stock for the par value of the shares. That's 100,000 times 1 peso, 100,000. And we credit APIC, or additional paid-in capital, for the excess of the market value over the par value. That's 8 minus 1, 7 pesos, times 100,000 shares, 700,000. Stock price contingency is an additional consideration that the acquirer will pay if the market value of the shares go below 8 pesos. We record this as credit estimated liability on stock price contingency, 200,000. Now the balancing figure amounts to 290,000 debit. Hence, that's goodwill of 290,000. Goodwill may also be computed as follows. Consideration transferred, which consists of 100,000 shares at 8 pesos market value each. That's 800,000. and stock price contingency of 200,000. The total consideration transferred is 1 million. The fair value net assets of the acquiree is computed as follows: 350,000 plus 810,000 minus 450,000. That's 710,000. 1 million consideration transferred minus 710,000 fair value net assets. This gives us goodwill of 290,000. For stock acquisition, we debit investment in subsidiary for the amount of the consideration transferred, 1 million. Credit common stock, 100,000. APIC, 700,000. An estimated liability on stock price contingency, 200,000. Observe that in a stock acquisition, we do not record goodwill or gain on bargain purchase separately. PFRS 3 defines business combination as a transaction or other event in which an acquirer obtains control of one or more businesses. Based on this definition, we can derive two key aspects, which are control and business. Let's now take a more in-depth look at these two key aspects, starting with control. An investor has control over an investee if all of the following elements are present. First, power over the investee. Second is exposure or rights to variable returns from the investor's involvement with the investee. And third, the ability to use power over the investee to affect the amount of the investor's returns. Control is presumed to exist when an entity has more than 50% ownership interest or voting interest in another entity. However, it's possible for an entity to already have control even if it does not have more than 50%. In the following instances: an entity has power over more than half of the voting rights because of an agreement with other investors. It has power to control the financial and operating policies of another entity because of a law or an agreement. It has the power to appoint or remove the majority of the board of directors, or it has the power to cast the majority of votes at board meetings or equivalent bodies within the entity. The second key aspect to the definition of business combination is business. PFRS 3 defines business as an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to customers, generating investment income such as dividends or interest, or generating other income from ordinary activities. A business has three elements which differentiate it from a simple asset or group of assets. These three elements are inputs, process, and output. Take note of the following scope limitations of PFRS 3 business combinations. Within the scope of PFRS 3 are the following: combinations involving mutual entities, and combinations achieved by contract alone or dual listing stapling. The following are outside the scope of PFRS 3: accounting for the formation of a joint arrangement in the financial statements of the joint arrangement itself, combination of entities under common control, and asset acquisition. The main agenda under PFRS 3 is the determination of goodwill or gain on bargain purchase using the acquisition method. The acquisition method has the following steps. First, identify the acquirer. The acquirer is the entity that has control over another entity. This is important because All the accounting procedures that we will be learning in business combination are from the perspective of the acquirer. Second is to determine the acquisition date. The acquisition date is the date when the acquirer obtained control over the acquiree. This date is significant because in business combinations, whenever we say fair value, we often mean to say fair value at acquisition date and not on any other dates. Third is to recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. And then lastly, we recognize and measure goodwill or gain from bargain purchase. The computation for goodwill or gain on bargain purchase can be summarized using the following formula. We start with the fair value of consideration transferred. Consideration transferred is whatever the acquirer or parent paid or transferred in exchange for control of the subsidiary or acquiree. Consideration transferred may include cash, non-cash assets, shares, or other equity instruments of the acquirer, and liabilities, including contingent liabilities. Next is fair value of previously held equity interest. This applies to acquisition in stages. Say that an investor previously had 30%, but by adding 40%, the investor now has 70%, which gives the investor control over the entity. Now, the previously held equity interest of 30% is remeasured to fair value on the date of acquisition. This is similar to significant influence obtained in stages, wherein the previously held equity interest is also remeasured to fair value on the date when the investor obtained significant influence. Next is non-controlling interest. Non-controlling interest refers to the interest held by other investors aside from the parent. So if the parent has 80%, then the non-controlling interest is 20%. If the parent has 60%, then the non-controlling interest is 40%. The sum of the first two amounts, the sum of the fair value of consideration transferred and the fair value of previously held equity interest, is actually the fair value of the controlling interest. The sum of the fair value of the controlling interest and the fair value of the non-controlling interest gives us the total fair value of the subsidiary or acquiree. Thus, fair value of identifiable net assets, the difference is goodwill or gain on bargain purchase. In the next video, we'll go over each of the steps of the acquisition method in more detail.